What's up, guys? Welcome back to GTech Finance. Hope you're doing well. Hope you're staying safe. So, oh man, we're gonna need some really life insurance for this. So, because what's happening now is bloody, bloody, bloody. It's all dropping. Like I said before, we thought we were buying the dip, but now no one knows which dip we're actually buying because, well, there's lots of pain in the markets and there's lots of things going on. So I figure, hey, you know what? Let's talk about it right now. Even though it's midnight, I should be sleeping, but yeah, screw it. There are three things that are happening in the market right now that I think are very useful, and we should understand them going forward in the next few weeks. Number one, we've reached the end of Don't Fight the Feds. We've changed our stock market focus in an entirety. So I'm not really including myself because I haven't changed my focus, but the market has changed it big time. Rather than the market trying to price in 18 months down the road, which we've talked about regularly since, not me, but a lot of people have been talking about it since March 2020 through this. So from March through December, the stock market was pricing in 1 year to 18 months, and it's so about 1.5 years out. But lately, it feels like the market is barely pricing in 6 months forward. The reason for this is because the market is so focused on short term that it has a lot of fears, and all of a sudden, don't fight the Fed, which was literally a way of saying just keep investing because Jerome Powell is bailing you out, which is obviously not a strategy that I endorse, but it is one of the market has been doing. And now it transitioned to don't believe a word the Fed says. They have no idea what they're doing or what they're going to do. They're going to lose complete control over inflation. They're going to have to change their mind. They're going to have to raise interest by 2022 at the latest. And the market is pricing in all that potential damage from the Fed having to get forced into changing their opinion and their strategy sooner than expected. That's basically what's happening here. And it's nobody believes that the Federal Reserve is going to be right about inflation. And when I say nobody, I know there are some people that do, but the big majority of the market doesn't. So that's a big problem here. The mass market, the average of the market, doesn't believe that Fed is going to control inflation. So if you got, for example, Goldman Sachs for some reason that went and dumped $10.5 billion worth of stocks last week, which had an impact on the market, somewhere around $35 billion specifically to companies like Viacom, Tencent, and Baidu. And now some people say, hey, well, this is because of renewed Chinese trade tensions between US and China. So look, we've always had Chinese tensions, trade wars, and they have always spooked the markets before. But others say no, because it's inflation, it's coming, we know it. Jerome Powell is just sticking it in their head because they don't want it to be wrong. Now, they will be, that's what I think. Others will say no, these are just, like me, Kevin would call them, market weenie babies or paper-handed sissies who are trying to follow the trends of what their customers want. And this is what I call a switch to the short term, because before we were much longer term. That's a rotation to cyclical and banking style stocks, recovery style stocks, that basically make fund managers have the ability to say, see, look, we don't invest in tech stocks anymore. We invest in cyclical rotation recovery stocks. Don't sell out of our funds just yet. Don't worry, we're moving to lower beta stocks, stocks that are less exposed to the madness and swings of the market. We're getting out of those high beta tech stocks. We don't want to be around those. And what's happening? Well, when the entire market does that and the entire market starts freaking out about short term, they move from tech stocks, which are because of bond yields going up and sell-offs in high value stocks, aka tech stocks, particularly Tesla. So because Tesla is actually when, let's say, the Nasdaq goes down 10%, then you'll see Tesla dropping 2, 3, 4x, so potentially a 40%. That's when the Nasdaq does a 10. On the flip side of the coin, if Nasdaq goes up 10%, not Nasdaq, sorry, the S&P 500 goes up 10%, then Tesla is going to go to 3x. So it's risky, but usually it's good. Now, in this case, we're in like the bad side of it because it's selling off. It happens. And you get online consumer retail even selling off in some cases, and this despite people spending more and more money, at least according to MasterCard, people spending more of their stimulus money than they ever have in the past. This is a good sign for the economy. Velocity of money is going up, it's circulating quicker and all, and we should be good about it. The thing is, when the economy is doing well, the stock market goes down, and then when the economy is doing bad, it just goes up. I can explain that. And the thing that shocks me the most is that GameStop is back at $200. Okay, let's keep that aside for now. So looks like it's still heavily shorted and they're like proud of it, but The thing is, unemployment rates are down month over month. Inflation is down. We're showing CPI data coming out month after month. It's good. The market is so focused on what's going to happen over this next 6 months. They're so worried about, well, fund managers are so worried about losing clients because they're not exposed to the recovery stocks that we have, undoubtedly a very, very strong rotation to fight the Fed. Fed is wrong. Fed will get it wrong. They don't know what they're doing. Let's rotate into value recovery stocks that we're seeing right now. So it is what it is, I guess. Anything that occurs in the news right now, any little bit of news, because there's very little to none. And interestingly, there's little news. Any news becomes important. That's where we can talk about this short-term transition to fears over things like, yes, the Suez Canal is still blocked. Look, it's easy to dismiss the fact that the Suez Canal has a ship stuck in it because people say things like, oh, it's just one ship. Oh, it's just blocking 12 of the world's transit. It's just impacting, it's just halting $9.6 billion worth of trade, worldwide trading a day. And what do I get on a new video about it? People telling me Joe Biden. Look, I don't really like Joe Biden. I don't want to get into politics right now, but this has nothing to do with the Suez Canal being blocked by a ship. So I'm not saying I'm with him by any means, but I'm actually with kind of none. I live in Lebanon. I don't really know a lot about politics, but yeah, it has nothing. I don't think it has anything to do with it. So blocking 12 of the world's transit, it's just $9.6 billion per day. Not that big of a deal, but I think a fact that a lot of folks looking at the market right now are missing is the fact that what's happening in the Suez Canal is compounding this short-term thinking rotation of fund managers, and it's making it worse. Because the crisis in the Suez Canal is not a crisis about a ship being stuck. It's a crisis about inflation. Again, the crisis over inflation is just reiterating people's short-term fears are all of a sudden went from being very, very long focused on 12 to 18 months out to focus on the next 6 months. We talked about last time how you're going to start paying premiums for the products to come faster because you're going to have shortage in a lot of things like computers or maybe chip shortages or anything, and you're going to have to start paying premium. More money is going in, so inflation is going up because velocity of money is going back up. So I totally believe that the next 6 months are going to be very difficult in terms of inflation in America to see some pretty high year-over-year inflation from the stimulus checks. We're going to see another package pass probably regarding the infrastructure plan, which might not be just $3 trillion, it might be $4 trillion. A lot of fears are going to come out of the next 4 to 6 months here. Personally, I believe after this 4 to 6 month period, we're going to be in a period of realization that, wait a minute, really inflation was temporary. It went away again. How is that possible with all that money being printed? It's because our market's going to boom. Our economy is going to be on freaking fire. But right now, the stock market only cares about the next 6 months and the pain we're seeing in the United States. So let me answer, why does the Suez Canal matter? Well, folks, we already have coveted hammered logistic systems. It helped us get all of the things from cars, computer parts, phones, commodities, certain foods, livestock, coffee, you name it. So literally, name a product and it's screwed because of what's happening in the Suez Canal, because it can't go from China or India or anything in Asia through the Mediterranean Sea to eventually the Red Sea to Europe. The Suez Canal may only affect 12 of the world's transit, but guess, 90 of the world's transit is done by this ship. 90% of the world's retail trade is done by ship. When you get one ship stuck, guess what happens? The price of everything, from the space at ports to cranes, to crane operators, to containers, skyrockets. And not only have those, or those prices will skyrocket, but you have insane delays. And if we go back to the beginning of 2020, a 40-yard container cost $1,500 to ship. Today, or before the Suez Canal disaster, cost $4,000. So that's a lot, like 2.5 times as much money as, more than 2.5 times it costs. Now the Suez Canal crap can make it even worse. And that's not what we want. Because Wall Street Journal last week reported that a typical dealership in Utah usually has 200 Ford Ram pickup trucks in stock. This week they only had 25. The Suez Canal doesn't matter. No, not at all. It matters a lot. When NIO is having to shut down part of the factory 5 days starting from December 29th, which is going to cause their estimates to go down from 20,000 to 20,500 vehicles straight down to 19,500 because they don't have enough chips, you start realizing how tight this is. The logistic systems in our world are tight, and that's because the logistical systems are tight because of profit. Everybody wants to maximize profit. Everything is run at the pace of what's just called in-time delivery. In other words, if I am manufacturing a car, let's say this is a car. Oh, wait, do I have anything? Say this is a car, this hand sanitizer. Show up after 2 months ago, sitting on a shelf somewhere. I want the door handle ideally showing up 5 minutes before I need to install it. That's called just-in-time delivery. Now it's not down to be at the minute, but that would be ideal. Then you're not inventorying anything, any product. Then boom, you install it, and now what we need is 2 weeks down the road, we're installing the tires, although the tires just showed up today. Like, that's the ideal capitalistic vision of having perfect logistical systems and therefore maximizing profits. When you have one ship blocking 12% of transit in a realm that affects 90% of retail transit, for products, you got big freaking problems. So I don't want to try and flood this right now because the reality is twofolded. So the reality is, if this ship is freed up by Monday, we should be able to get through with this interruption. We're just going to call it some kind of correction. If the global impact should be minimal, if this ship stays stuck, and look, we've got high tide coming on Monday or whatever, full moon, water levels are going to go up 12 feet. They were talking about that on Bloomberg Business. I saw that like 100 feet, it's still stuck. They're making progress, but they're just basically hoping at one moment kind of like freeze. That'll be really awesome. But anyway, right now, if that does not happen by Monday, we are going to start having some pain. And usually this stock market thing stays for like 6 weeks. Now the 6th week is nearly done for this correction. But it would not surprise me for this ship to actually amplify those short-term inflation expectations that are killing the market right now. This is bad. And I mean, personally, I think Jerome Powell knows what he's doing. He's the head of the Federal Reserve. The Feds know what they're doing usually. They started, the first thing they did in March, that was like, even the pandemic just started, we barely had 15 cases worldwide. You just see him, first thing he did was emergency stuff. We're buying all the bond yields. They're plummeting to zero. That's what he did. And that caused a big inflation in assets already. We've seen it in the real estate market and the stock market. Everything went to the moon. But now we're going to see even more sell-offs, and it's kind of painful being diamond handler right now because there are lots of pains in the market and a lot going on. So I think that's it for today. If you enjoyed the video, hit the like button, subscribe to the channel if you haven't already, and folks, hope to see you guys next time.